All right, welcome back. It's the AVID Investor Podcast with me, your host, Josh Adamek. And today we're going to talk about the private equity model. What is it? What are the benefits and how does it work? So for those of you that don't know, the private equity model is how we operate at AVID and AVID Management Group and have done so for several years now. And to back up a little bit, in the previous episodes, we talked about different strategies, ways to invest in real estate, whether that's wholesaling, whether that's retailing, flipping, or whether that's building a rental portfolio and investing for the long term. And so today I wanted to dive in and tell you guys, how we operate at AVID Management Group and AVID Management Group and the strategies that we use to build, create and build our portfolios. And, that's done solely through the private equity model. So again, if we back up a little bit, many of you know that, I've been in the business for a long time, almost 20 years. I started buying rental properties in the early 2000s. Again, started with very little, pretty much no money, none of my own money. When I got into the business. So I started, from zero and built it up from there over time. And, a big part of my growth and my ability to build my business and grow my business, because I didn't come from money. I didn't have money. I had drive, I had dedication, I had desire to do, to grow my business and to do bigger things, and a big part of that was the financing. Obviously, if you have no money, you need to fund your deals, you need to fund your businesses, you need to fund your opportunities. And early on in my business and all through my career, the majority of my deals and my projects and my business has been, privately funded. And what that means is, I haven't worked with a whole lot of banks. I haven't done a whole lot of traditional bank financing. The funding and the financing has come from, private and institutional investors. And early on, we operated under a debt model where, I would work with a private lender, hard money lender, whatever that is, whatever it was at the time. We would secure the deal, we'd get the deal, and then we would, go to the investor, present the deal, they'd commit, and then we'd move forward with the project. So, and that would typically be done, in the earlier years under a debt structure. So I would be the borrower, they would be the lender. Very, very common, asset-based lending in real estate. So that's the debt model. And then, we transitioned in 2017, that would be many years into my career. In 2017, we shifted. I learned the private equity model, and I'm not gonna tell you that it's something that I vetted, I created. I'm not taking credit for anything. The private equity model is something that I learned, a strategy and a system that I learned from a very, very good friend and mentor of mine, John Burley, who had designed the model in the early 80s and has proven the model to work over many decades and multiple market cycles. So it was a proven strategy that I learned in 2017. I committed to some very in-depth, detailed mentorships and training. I learned the model and then adapted that model and implemented that model into my business. And it was a total game changer. So I'm very passionate about the private equity model, what it's done for my business, what it's done for my investors and my partnerships. It was a total game changer. So I wanted to take this episode and dive into the details of, how the structure works, what it is, and what the benefits are. So first off, it's the private equity model. It's not a REIT, it's not a pool, it's not a fund. It's a partnership. It's a partnership. It's a one-on-one partnership and a relationship between the management company, the managing partner, and the passive, the investment partner. So what I've learned over the years in my career is a lot of the private investors that I work with, the accredited investors that I work with, some of the institutional investors that we work with, they're not necessarily, looking to knock it out of the park with returns. They're not looking to get into, the risky type transactions that have, these massive, projections, because let's face it, everything looks good on a spreadsheet. A lot of the investors that I've worked with and the partners that I've worked with over the years are, business owners, athletes, professional athletes, some older folks that are looking to, be a little more active with, or, put their retirement funds to work. We've worked with individuals that, investors that, use self-directed type IRAs and those types of investment vehicles to create and manage these portfolios. And what we've learned over the years is, these investors, they're not looking for, huge risky returns. They're looking for safety and security. They're looking to, more so, not hit huge returns, but just, put their money to work, have their money active. They're looking for, capital preservation. What can I do with my money where I can make a return, where I can get something that's safe, secure, predictable. And, that's what we've done over the years with our private equity model is, we focus on safety and security. We invest in, we build portfolios, create and manage portfolios of single family homes. So I call it, regular houses, regular neighborhoods. We invest in the median price point in the Pittsburgh market. So are there opportunities where we can go out, we can do, riskier type transactions and make, better cash on cash returns? Yes. But we've learned that, our investor partners, that's not what they're looking for. They're looking for safety and security. In the private equity model, again, it's a partnership. It's a one-on-one partnership. So rather than a lender-borrower type scenario, when we create a partnership with one of our investors, they're a partner, they're an owner in that portfolio, in what we've built, what we've created. So with ownership, there's cash flow. It's a long-term play. There's tax benefits when you own real estate. Yes, the real estate appreciates and it goes up in value over time. But the benefit, one of the things that real estate offers is depreciation and tax benefits and the ability to take expenses against your portfolio and your what you've created. So it helps to offset some of that income. So there's tax benefits. There's a predictable rate of return. Again, we're investing in regular houses, regular neighborhoods. It's safe, it's secure, it's predictable. Regardless, we choose to invest in, median price points, B-class neighborhoods, because over time it's proven, they're more stable, they're more secure. In Pittsburgh, I mean, if any of you are from Pittsburgh and have been in Pittsburgh or in the Pittsburgh market for a while, more than a decade or more than 2 decades, you'll know that there's always a need for regular houses in regular neighborhoods, regardless of market cycles. We have portfolio of homes in B-class neighborhoods. When the markets are good, when the market's good, values and prices are up. The model that we choose to invest in the model that we choose for an exit is, lease options. So we place residents in a lease option type program rather than straight rentals. So when the market's up, we're seeing, more of our residents exercising the option to purchase and cashing out on their homes. When the market's down, when we're in a correction period, we're seeing slightly higher rents because there's more demand for the homes in portfolio. We're seeing, better resident pools because, when there's a correction, the B-class neighborhoods, the regular houses, regular neighborhoods, again, they're not subject to the market cycles as much as, the higher markets. So when the market corrects, and folks are moving out of the, unfortunately, maybe losing their homes in the higher markets, the higher dollar markets. They're back in the B class neighborhoods, maybe where they should have been all along. So there's always a need, there's always a demand for regular houses, regular neighborhoods. If we talk about the long-term play, the long-term strategy, we set the private equity model up so it makes sense from a cash flow standpoint for the long term. If our residents, choose to cash out on the property or choose to exercise their option to purchase the property, we have the opportunity to replace that, to buy another home, maybe buy two homes, add more homes to portfolio. So, if we talk about, capital growth, again, it's a long-term play. So there's, when we buy the properties in portfolio from day one, we have certain parameters. We have a buy box that, we buy certain types of properties. We look for certain ratios. So we look for certain cash flow returns. We look for certain equity plays. And of course, we invest in certain neighborhoods in and around the Pittsburgh market. So our go-to is, regular house, regular neighborhood. I've probably said that a dozen times already, but that's what we invest in. And, if you're from Pittsburgh, it's grandma's house. For me, it was grandma's house. Your 1950s brick ranch, 2-story Cape Cod, whatever it is, we don't necessarily, buy homes in that are older, that are, 100-year-old with sandstone foundations and, knob and tube wiring and slate roofs and all that stuff. We have some of those homes that we bought and they've made sense. They make sense at the time we buy it. We buy them, but our go-to is just like your 1950s brick ranch, 2-story Cape Cod, whatever it is. When you get into the higher, when you get into the bigger homes, the higher price points, I mean, they cost more to own and manage. So we just look for that. Again, it's probably like a 900 to 1400, 1200, 1400 square foot, box. That's our go-to type properties with for the portfolio for the long-term plays. And again, what allows us to buy these homes and create these portfolios is the partnerships that we create through the private equity model. And with when it comes to creating the partnership, again, these are these folks that we're working with to create the partnerships. They're typically private, accredited, and sometimes institutional investors. They're folks that are typically higher net worth, that are either too busy with their business, their careers, that they don't want to be an active investor. They're looking for, passive investment type opportunities. So what the benefit that we provide to our partnerships, to our partners is, we provide the opportunity for them to own real estate, to get all the benefits of owning real estate while we handle the day-to-day management. So in a nutshell, I mean, that's the private equity model. That's how it works. And again, it's not something that I created. It's not something that I Googled. It's not something that, I learned on a website or, something like that. It's a proven model. It's a proven strategy that has been proven to not just work through down markets, but it actually, in all reality, in all honesty, the equity model, the private equity model actually, thrives in a down market. So, when the market's down, we have the ability to, buy homes better. And again, it's a long-term play. So if we're in a correction period, the market's down, we can buy homes at better prices. We can place our residents and let the market do its thing. In an up market, we still have the ability to buy. I mean, we just have to, in all honesty, we just have to work harder to find the deals that the opportunities that fit within our buy box. So regardless of market conditions, if you're creating a portfolio, it's a long-term play. We're in a down market. It works better. we're in an up market, it still works really well. I'm not saying that we only want to buy in a down market, because we buy, regardless of market conditions. It's just, um, for us on the management side, we got to work a whole lot harder to find the deals that fit within our buy box. But that's what we do. That's the value that we provide to the partnership. So, not without diving into, too many of the details, with agreements, things like that. I just wanted to go over, a high level overview of how the private equity model works, and the benefits. So, and as far as the structure in general, it's not a fee-based management company. We're not a fee-based management company. We're a partner in the equity model, in the portfolio that's built. So it's designed as a win-win type scenario, where, with the management company, my team being a partner in the portfolio, the better the portfolio does, the better we do, the better the investment partners do. It's a win-win. The better properties we buy, the better numbers we hit, everybody wins. The better we do on management, on placing the residents, on the day-to-day management, on handling the turns, on addressing, any issues that arise, the more efficient we are in handling those issues, in addressing those issues, everybody wins, because, everybody does better. I've seen in the past with a fee-based type management company, they're fee-based. So, they may or may not be looking out for, the best interest of the owner, of the property owner. Of course, they want to keep a good relationship with that property owner. And of course, they want to, properly, manage that portfolio. I'm not discounting any property management companies. I'm not talking trash on any property management companies by any stretch of the imagination. I'm just saying with the private equity model, it's designed as a win-win type scenario. So the better the portfolio does, the better everyone does. And again, with the equity model, we do regular houses, regular neighborhoods. There's no limits, as to the number of homes we can buy, the number of, portfolios that we can create, because there's, it's regular houses, regular neighborhoods. So if you want to learn more about the private equity model, if you want to talk to me, we can connect offline. I can dive into some more details, over the phone, or maybe meet up in person, or whatever. We can discuss, how the model works. If you're looking to be, on the active side of the private equity model, if you're looking to learn, more, or maybe take part in the in-depth training that I did to learn the private equity model from a management side, it's no secret. I learned the model from a good friend and mentor of mine, John Burley. Unfortunately, if you're just hearing this now, he was in Pittsburgh a couple of weeks ago. He spoke at our monthly acre meeting, so missed out there. But connect with him, find him on social media. There's the John Burley Real Estate Investing Facebook group. You can connect there. He does several events each year. I think it's limited to maybe 3 to 5 events each year. But if you're really interested, if you really want to learn that model, he is out in Arizona. So, you would have to make travel accommodations to, attend his events and learn those models. And, as I said, I'm not taking credit. I didn't create anything. I learned a proven model and a proven strategy, and put that strategy to work in my business. And we found that, the investors that we were working with prior to the adopting the private equity model, we've shown them the equity model, and many of our investors have converted to equity and created portfolios and done very, very well. We've created new partnerships with new equity partners who have learned the model. Again, we work with guys, investors, guys and girls, investment partners that are business owners, that are athletes, that are maybe older folks gearing up towards retirement, or looking to do something with their retirement type funds. where they can get a return, get some equity, get some cash flow, and some tax benefits. We have those partnerships, but again, what we've learned, in adopting this strategy and implementing this strategy is, it's not necessarily about knocking it out of the park with returns. It's not necessarily about investing in that class A complex or class A commercial property. It's safety and security. That's what our partners are looking for. That's what we offer: safety, security, cash flow for the long term investments. Many of our partners are so busy with their business, their other commitments, that they don't want to be bothered with cycling and replacing their money every 3 months or 6 months or something like that. They want to put their money to work and know that it's safe, it's secure, and that it's for the long term, and they're going to keep getting those cash flow checks and the distributions, and then the tax benefits, capital growth. It's all there with the private equity model. So that's it. In summary, that's how we operate at AVID, and AVID Management Group is under the private equity model. If you want to learn more about the private equity model, let me know. Drop a comment, reach out. If you want to learn more about the private equity model from the management side, I'd be happy to guide and direct you with that. But I would really refer you to connecting with my friend and mentor, John Burley, whether that's going out to one of his trainings, or whether that's just grabbing the book. Money Secrets Money Secrets of the Rich was a national bestseller written by John Burley. It doesn't discuss too many details of the private equity model, but it gives you a general understanding of John Burley's principles and teachings and thought process. So that's what I have for today. I appreciate you guys, and thank you for tuning in. Thank you for listening. We're at episode 20 here, so I've had a lot of people reach out to me and said that they've listened to all the episodes and they found value in the episodes. And again, I don't have anything to offer here other than, content, and hopefully I'm adding some value to you guys and your business. And if you find that to be true, if you're finding value in the message that I'm delivering, all I ask for in return is just, share this post on social media, send this link to a friend, business partner, relative, or associate of yours that could benefit from this message. Just, help me spread the word. So thank you and have a great day.